Hey everybody, this is Russ Story Wealth Management Group here in Douglas, Georgia. It's that time of the week again. I'm about to do Money Matters, the radio show where you can hear us on Thursdays on WDMG, your community station. We'll be, our show airs at 11 o'clock every Thursday. And then down in Tallahassee will be 5 o'clock drive time on Wave 94 FM down in Tallahassee. So you can also go to our website, storywealth.com, and you can download this program there as well. And hopefully you'll get something out of this, either you or a member of your family. But we got a few things we're gonna go over today. We're excited about the show, and we appreciate you joining us here today. First of all, I got a couple of things I want to mention. There's a lot of people suffering out in Texas, the Houston area. There's a lot of things going on, and I think we should say a prayer tonight for those folks, the victims, those people who have been displaced, those folks without power, water, food, and there's a lot of real problems out there right now. So we at Story Wealth Management Group, I want to announce that we are a drop-off center. If you have some canned goods, if you have some water, if you have some blankets and some things of that nature, I understand they need those. You're welcome to drop it off here, and we'll either get it out there or we'll get it coordinated so that it can go to the relief efforts. So I just want to mention that if your heart tells you to let's participate in helping some of these folks, then that's wonderful. And if you're able, then come give generously, and we'll get it over to where it needs to go. So, my name's Russ Story. I'm a financial advisor. I've been doing this for about 25 years. I've been advising clients every day, day in, day out. We meet with folks and we help them solve tough financial problems. We handle an awful lot of investable assets on behalf of our clients, and we're very blessed, and we understand how fortunate we are to do what we do. So I've been a financial advisor here in Douglas, Georgia for a number of years. We've got clients all over the United States. But if you have any questions or concerns about anything we talk about on this program today, I'd appreciate it if you talk to your financial advisor, whomever that may be. If you don't have a financial advisor, you can certainly give us a call. Our phone number is 912-384-0030. So give us a call, and if you have any questions or concerns, or as I said, talk to your financial advisor and see if they can help. We are at 210 East Ward Street in Douglas, Georgia. And a couple of things, I got a couple of announcements. One is the Childhood Cancer Awareness Drive that has started in Douglas, and it's that time of the year. On September the 22nd, there will be a silent auction, and a silent auction at the downtown square. It's in the middle of town. It's a wonderful facility, and it's in beautiful historic downtown Douglas, Georgia. So also on the 23rd at 7, they'll have a live auction, and they'll auction off some things that are donated, some trips and things of that nature. And be sure, if you make your plans now to attend, and that's on September 23rd for the live auction and September 22nd for the silent auction. So I believe that's a Friday and a Saturday. So also we're having our seminar in Tallahassee, Florida at Capital City Country Club. It's going to be September the 28th. It's going to be at 6 o'clock. That's when it's going to start. We'll fire up the main engine there. We'd encourage you to, if you have any questions, if you're looking toward retirement in the near future, if you're in retirement, there's an awful lot of things that we're going to cover. And we get an awful lot of feedback. This isn't the first one of these meetings we've done. We've been doing this for a number of years. So I'd encourage you, or a member of your family, if you have some friends, I'd encourage you to go on our website and go ahead and register for the event, because we do have limited seating. So give us a call at 912-384-0030, or go on the website and register online, storywealth.com. Storywealth.com. Go to the events tab and go down where you can see the events, and you can see a registration button right below that. So anyway, we'd love to see you in Tallahassee, and we look forward to being there in that neck of the woods on September 28th. I got several things I want to talk about money-wise here today. I want to talk about a particular type of investment called a real estate investment trust. And I'm going to just talk generally about some things and the way that works. They're quite popular investments, and we're going to talk about sort of how they work, some pros and cons, and we're just going to have a general information time about those type of investments. Also, we're going to talk a little bit about your president. And one of the things that we hear all the time from some areas of the media is how terrible he's doing, and how terrible his ratings are, and they keep doing these polls and they keep telling us that nobody likes our president, and we're going to talk about that in just a minute. Also, I want to talk about investors beginning to prep for a market downturn and disruptions. Now, this was in Pension and Investments. There was an article recently that I had an opportunity to read. It was referred to me by one of my associates, and I really enjoyed the read, and it sort of tells me a little bit about what some of the institutional money managers are doing. And a lot of times these guys are a little bit ahead of the curve. You know, we as individuals, sometimes we're busy doing what we do, but these guys are paying a lot of attention to their investment portfolios. We're going to talk a little bit about how they may be beginning to prep for market disruptions. If we have time, we're going to get into some Ivy League stuff. We're going to talk about Harvard, Yale, and some of these big endowments that these big universities have and these colleges have, and how they manage those, and how they do some things that maybe we as retail investors can learn from. Imagine that, learning from a college or a university. That's not a bad thing. So anyway, we're going to talk about that a little bit if we have time. So I'm going to jump right in. Let me see how much time I've got here. We're rocking along in about 7 minutes. So So we've heard about how your president's doing such a horrible job, and we hear that nobody likes him anymore. A bunch of folks voted for him, but nobody likes him anymore. So a couple of things I want to mention. You know, I was looking, my firm is owned by Cetera, and my broker-dealer, and Cetera has a research department called Tower Square, and they do a great job from time to time. They have really insightful articles and information that I use and I share with my clients so that we can make good decisions going forward. One of the things that was addressed recently in this article on Sightline was it was 8/21/17 is the date on it. And one of the things that I got out of this was that America has become more polarized. I think you would all agree. When it comes to politics, opposing parties don't agree on almost anything anymore. We seem to be quite polarized, and to a lot of folks like me, and I'm sure a lot of folks, we feel like we can't come together enough to get anything good accomplished sometimes. So that's frustrating for me, and I'm sure a lot of people that are listening to me here today. But I think it would be a mistake to mix politics and investment management so much. And what I mean by that, and what the article mentioned, was that equity returns can be favorable when, under either administration, either a Democratic administration or a Republican president. So, bear markets have occurred under both parties' leadership in the White House. And, the fact is, while nobody seems to like President Trump, the market just keeps marching on. So I believe the S&P's up about 17% since the day of the election, and I'm quoting some numbers out of that article. So that's pretty interesting. If you would like a copy of this, you can send me an email, Russ, rstory@storywealth.com, rstory@storywealth.com. Just a quick read there, and it talks a little bit about some facts and figures about, it's not uncommon for a president to not necessarily have huge favorability ratings at one point or another in their presidency. So this is nothing new. It's nothing, in my opinion, that's catastrophic. And I believe that hopefully we can get some tax cuts in there, and maybe things will start moving in the right direction and continue. So, speaking of continuing, speaking of things going up, speaking of things doing well, I want to talk just briefly about what I see going on. And one of the terms that we talk about, I talk about the bull-bear clock a lot. And typically the market's gone down about every 3.5 years. Since 1929, I'm going in and I'm quoting an article piece that actually it's a Swan Investment Management has a piece that talks about every 3.5 years on average since 1929 the market's gone down. Typically it goes down on average of about 35% according to the brochure, according to this piece. They also say in the marketing piece that it can take a long time before markets can actually recover and come back. So one of the things that we like to do here at Story Wealth Management Group, we hear about buy and hold. That's what you got. You just buy and hold. And we at Story Wealth Management have a little different approach to that. We believe in buy and hold, all right, but we also believe in buy, hold, and sell, because we know there's a bull-bear clock, and we might not be perfect. In fact, we're not, as far as what we are calling the market and whatnot, but we do use several tools to try to give us an indication. One of the things is just pure duration. If you look, and if in fact every 3.5 years the market goes down, and it goes down an average of 35%, let's just assume that as being the case. Excuse me. Then, as I said in last week's show, 12 o'clock is kind of when the clock strikes 12, it begins the downward cycle of the market for a while. It starts going down for a while, and then it starts going back up. About 6 o'clock, it sort of starts coming back up again. Okay, so if that's the case, then where do you think we are in the bull-bear clock cycle? If the market goes up, and you can look at a chart, any chart you can pull up on the internet, SPY, go in and look at, that'll show you an easy ETF that tracks the market for a while, going pretty a few years back. But it'll go up and it'll go down, and it'll go up and it'll go down. You say, well, Russ, yeah, it always goes up. Well, one of the things that a lot of people don't realize is that sometimes weathering market downturns can really be detrimental to a client's portfolio. There's a sequential return formula there that we as financial advisors look at, and I know a lot of people will say, well, Russ, I got money in my 401k, and I'd like to talk to you a little bit and maybe get some advice. I got an investment account. We don't have anything. In other words, the market goes down. I know my account's going to go down, but it's doing so good. We just need to keep doing. I just feel comfortable with it. It's doing good, and if it starts going down, then let me tell you what. The bull-bear clock, in my opinion, is not a matter of will the market go down. It's a matter of when. And if my hypothesis is right, then the bull-bear market is. We know that it's been going up for almost over 9 years, according to this particular piece that I'm quoting with Swan Investments. So it continues to go up, and then so where are we? Do you think we're at 9 o'clock? Well, I mean, if every 3.5 years the market goes up, and it's been 9 years, there's a chance, we don't know, that it might be at 11:59. So, and then the market might go down for a while. So one of the things that we talk about, there's a term called snuggling up their stops, okay? And I guess that's kind of but what they're talking about sometimes, institutional investors will, in fact, really go in and if they've got a profit in a position, many times they'll go in and put a sell stop order in so that if the market begins to come down, they'll sell out, and it'll kind of, locks in their profit at whatever they sell it for. So there's a lot of things going on right now. This is an article, August 21st. I'm getting some of this information from Christine Williamson. She wrote this article, and I thought it was pretty good. Market change is coming. Exactly when, where, and how it will happen is unclear. Boy, she said a mouthful there. But basically, she says a growing number of asset owners and money managers repositioning their portfolios to ride out whatever comes next. Now, whatever comes next, and talking about riding it out, that is not very positive sounding, is it? Market pundits, chief investment officers, portfolio strategists interviewed by Pension and Investments said odds are against a U.S. or major global recession in the next 12 months. However, they agree that this bull market, this 9-year bull market and the 30-year fixed income bull market are at the late stages of their cycles and are vulnerable to disruption. So this is what I've been saying on the radio show here for quite a while, if you remember. I've been talking about this. So what are we talking? Well, you know, it was written that BlackRock, some of these investment companies have reallocated assets to where they believe valuations are more reasonable. So they've kind of made some changes perhaps to try and be in the value type sectors of their chosen investment class. There's quantitative easing is coming it's coming at some point, coming to an end, and some say there's never been anything quite like this. So we could have as the Federal Reserve unwinds its balance sheet and starts putting these bond investments back into the market, it can really shake things up. We got the advent of the ETFs now, and there's a lot of things that really could happen that could be, we really don't know how everything's going to shake out. But, it seems, according to this article, a move toward more active money management to try and help put in place risk strategies. And I'm reading here where it talks about a lot of the institutional money managers have gotten a lot more defensive. Okay, so I think that historically, in my opinion, these institutional money managers have done a really good job at managing risk compared to the individual investor. They sometimes, it's my opinion, they're telling you to just invest and hold and buy some more, but they're not doing that themselves. And it's my job to try and look after my clients and those folks that I am committed to look after or trying to assist and help. So it seems, based on this article, a lot of money managers are reducing their exposure in what they call traditional asset classes. Traditional asset classes are typically stocks and bonds, stock and bond mutual funds. Those are very traditional. Maybe some alternative investments, which we'll talk just a little bit about that. I want to talk about quickly a REIT. Talk a little bit about what a REIT is, Real Estate Investment Trust, and you may or may not have heard of such a thing, and that's cool. But I want to talk a little bit about it and tell you, because this is one of the investments, and alternative investments can be in the structure, in a REIT structure, and thereby they can more broadly diversify a portfolio for sure, and in my opinion, maybe reduce some risk. But there's some pros and cons to these type of investments, and what I'm about to tell you is in no way a recommendation, or in no way am I advising you to go out and buy these on your own. And to the contrary, if you hear something that I'm talking about here today and you think mine can help you, I'd encourage you to go see your financial advisor and talk to them about what I talked about and see if it might be right for you. Again, if you don't have an investor or a financial investment advisor, more than welcome to give us a call. Call me at 912-384-0030. You want a toll-free number, 877-240-9787. And we'll be more than happy to talk to you. And, go to our website, send me an email. I get quite a few emails, and I always enjoy getting them. I appreciate your feedback, and some of the things that we talk about on this program, of course, come from you, the folks that are listening, and I certainly appreciate that because I need all the feedback that I can get, really. Storywealth.com. You can send me an email, rstory@storywealth.com, and that's STORY. So let's talk briefly about what a REIT is while we still have a few minutes. Real estate is really a unique investment class, and I believe that it provides, in my opinion, a balanced mix of total return and potential income, and it can also help better diversify a broader investment portfolio. Now, real estate consists of very sometimes large, illiquid, private real estate, and there's more tradable and accessible public real estate investment trusts, but private and public approaches allow investors access to real estate, but there's a number of distinctions between like a real estate investment trust and actually holding a piece of rental property or a piece of property. So I want to talk a little bit about that. I'm going to focus on these public REITs because there's also they're non-traded REITs, and I'm not going to particularly talk about those because typically each one of those have their unique set of risks, perhaps benefits, but that's something that I'll maybe cover on a latter day. But so to qualify, so the REIT is really in 2016. There's some different things going on. Really, there's lower leverage on some of these products now than there was at one time. The historical rates of return on a lot of them are very attractive. Now, to qualify for a REIT, to be called a real estate investment trust, the entity has to have the bulk of its assets and income connected to the real estate investments. So it's got to distribute 90% of the taxable income as dividends to shareholders. So you're getting kind of a pass-through there, and because of these requirements, REITs do provide a blend of total, can provide a unique blend of total return and income, and sometimes historically this has been kind of in between stocks and bonds. So it's a investment class that sometimes total return wise can kind of be between those two. Sometimes they might be better than the stock market, but again, it's a little different. Since the start of what we call the modern REIT era, which some would say is 1995, they have outperformed both stocks and bonds on a total return basis. So that's not too bad. The return is typically, your total return on your money is typically split about half and half, and that's half from rental income and half from appreciation of the underlying asset. So, by comparing that, equity returns or stock market returns have actually primarily been from capital appreciation or the value going up of the shares. So, they're typically income oriented. They're designed that way. Again, REITs may be able to help diversify your portfolio and may be able to provide a lower overall risk profile. It's one of the reasons I like considering these in a lot of investment accounts, and one of the reasons I recommend these in a lot of investment accounts is because REITs have had about a very low correlation to the S&P 500 really over the last 20 years, and that means there's better diversification benefits as compared to just a stock market investment alone. So negatively correlated means they act differently than the other class. So if stocks are going up, maybe these aren't doing so well, but if stocks go down, maybe the real estate investment trust sector, maybe the real estate sector is doing okay. One of the things that I think about personally, and I propose this for your consideration, if you have a REIT, a real estate investment, and people are living in this property that's being managed and owned by the REIT, and the stock market goes down 30%, do you believe people are going to continue to pay their rent? Well, probably. They'll probably pay their light bill. They probably don't want to take cold showers in the dark. And they'll probably don't want to be on the street, so they'll probably pay their rent. So to me, there's certainly some advantages to looking and considering these real estate type investments. Not only have they historically performed very well, but also going forward, it looks like the REIT cycle kind of began in 2009, and it's been lengthy, but long, persistent economic cycles in real estate have been very common historically, in my opinion, based on what I see and the data that I look at. So this may be something that might help us diversify some of the risks instead of just holding 100% stock market investments, perhaps. And again, we're talking today about ways to maybe consider things to consider to try and reduce risk to just stock market investments. And again, some REIT sectors have done better and are more negatively correlated than others, and those are probably the ones we want to consider when we're looking at trying to reduce or trying to increase our diversification. You don't diversify but because you're trying to get rich quick. Typically, you diversify your portfolio for safety reasons, to try and reduce over concentrated asset classes. So we certainly want to consider diversification, and I believe it certainly makes sense. Well, it's been a good time being with you, and I appreciate your time. I appreciate you hanging in here with me. We talked about a good bit. Remember, if you're concerned about Houston and Texas, you can come by here, or you can use us as a drop-off point because we'll get it out there. Story Wealth Management, 210 East Ward Street, Douglas, Georgia. Give us a call, 912-384-0030. If you've heard anything today and you think, well, gosh, I don't understand this, or I'd like a little more information because Russ is not making any sense, which I've heard that before, you can give me a call at 912-384-0030. Remember, Tallahassee, we're coming your way. Go on the website because September 28th, we'll be there and with bells on. So y'all sign up for we got great cookies. You don't want to miss the cookies, I'm telling you. So anyway, we talked a little bit about some of the institutional investors and what they're doing concerning risk. We talked a little bit about the president and the politics and why it's my opinion that the polls are not cause for running for the hills. And we talked about real estate investment trusts just a little bit, just a general information about them and how they make and help, and kind of also how they can help as an investment, an asset class, to perhaps reduce risk as far as more diversification for a portfolio. So that's enough of those big words, but it's been a pleasure being with you. We appreciate it. You guys have a safe and wonderful week and weekend, and I hope to hear you. I hope you listen to us and appreciate your support, and I'll see you back next week. Thanks.